Hi, I'm Charlie Jamieson, Chief Investment Officer at Jamieson Coote Bonds, and this is a review of markets in September 2020. Over the course of the month, major focus has shifted back to the Reserve Bank of Australia and some thinking in the markets that they could be on the policy warpath again in further cutting interest rates. It's very important to remember with the RBA that they are a tremendously reactive central bank. And they have misled markets with their own commentaries a number of times in recent times. And again, getting to this 25 basis point level, which they'd considered to be another new floor, it now looks like we'll be going lower again. Whether that's in October or November, we probably think November, but there will be further rate cuts. And that's very targeted to try and get the currency lower, in our opinion. Just on that reaction from the RBA, it wasn't long ago that they were telling us the neutral rate of interest in the economy was 3%. I think that's in a parallel universe in the developed world these days. Those rates just look far too high as we look around the globe. They kept rates at 1.5% for nearly 3 years from the middle of 2016 to 2019, telling us again that they didn't envisage going any lower. And here we are at 25 basis points, some 125 basis points lower. Clearly, COVID is the reason, but COVID, in our opinion, as we've spoken about, is really just the accelerator of slower moving secular themes and this draw to very low rates around the world. The RBA also told us that they didn't want to do quantitative easing. Quantitative easing is fully operational as we speak right now. And they are telling us that they'll look at negative interest rates, but they don't foresee using them. We don't want that to occur. Clearly, negative rates we think is a pretty ordinary policy. But nevertheless, with the Bank of England and the Reserve Bank of New Zealand also studying and making commentary about negative rates, it looks like policymakers are willing to throw everything at this problem of this, not being able to generate material growth in economies. And they'll try very unconventional policies following on from places like the Bank of Japan and the ECB. So absolutely watch this space. I wouldn't trust the RBA in their commentary at all around the outlook around a negative rate potential. In September, we had a stumble in risk markets. We've broken the momentum that's been so powerful off the lows in March and April. And we've seen a lot of things roll over. Clearly, the tech sector being fairly weak after a spectacular run. In many respects, the US dollar also finding its feet and the Aussie pulling back quite substantially. And that has maintained that negative correlation relationship that we speak of all the time between fixed income and risk assets. But with the RBA starting to make some mention that they might be pulling the policy lever and that stumble in risk markets, unsurprisingly, bonds had a very powerful performance over the September period, with all of our solutions generating good solid returns and our global unhedged having quite spectacular returns as a result of that currency depreciation. Again, in the month of September, we had record amounts of bond issuance, with the Australian government having an order book of $86 billion for its new 2026 maturity bond. They only ended up printing $25 billion worth of new securities, leaving material demand unsatisfied. That order book did get a little smaller when they tightened the pricing, but still it was north of $60 billion, just staggering amounts of demand for Australian bonds that, as we've written, remain very cheap in the context of global bond markets and have a very steep term structure. And we'll talk more about the steepness of that term structure in following episodes, because we do believe it's very important. We've got to the stage now, 28 September, where JobKeeper is starting to wind down, and this disaster relief stimulus that we've been so happy to receive as an economy is starting to wind back. So we do continue to foresee some problems ahead. We know that we are getting towards this northern winter period in Europe and the US, and already COVID case counts are going through the roof. Now, thankfully, I think testing is much better, and many of those presenting are much younger. So at this stage, we're not seeing universal lockdowns, but there have been some lockdowns, and it does look like that could certainly continue. It's very interesting to note that Trump's approval ratings have followed case counts and virus progression very closely, which also has had a very big impact on the US dollar and risk markets as well. So having just watched the first presidential debate, which was an absolute joke, I think there's a lot of confusion as to what will actually occur on the 3rd of November. We absolutely believe that we're off to the Supreme Court regardless of the result, and Trump will do everything in his power to frustrate that democratic process and try and desperately retain power. So there's probably plenty of twists and turns to come. We're going to be cautious with the way that we manage our own portfolios into that, given that there's so many potential outcomes which could be very binary and happen very quickly. Thank you very much.